Hello. This video is my attempt at distilling the information that I found reading several different publications that are analysis and insight into uh, the outlook for 2026 from a global macro perspective, from a macroeconomic perspective, and also from a geopolitical perspective. Although I'm mostly focusing on the economics here, or what I found regarding the economics here. What this video is not is a comprehensive breakdown looking at everything in incredible detail. It's just quick insights, quick takes, interesting things, places they mostly agree, places they might disagree, just the broad strokes of what I found in these reports, mostly for my own sake as an intellectual exercise. Also, it's not a perfect video. I was having trouble finding the time really to put as much work into this as I would have liked. And we're more than halfway into January and I hadn't put it out, so I thought, fuck it, let's just do it. Anyways, the reports I've looked at are the IMF's World Economic Outlook, Goldman Sachs Macro Report, Fidelity's Macro Report, KKR Insights Outlook for 2026, as well as BlackRock Investment Institute's Global Outlook for 2026, and Lazard's Top Geopolitical Trends for 2026. Primarily, what you're going to see mostly are me referring to Goldman Sachs, Fidelity, and KKR. Again, that's because mostly I'm looking from a global macro perspective, and also past a certain point it's just repetitive. There's not much marginal utility in discussing in detail 4 rather than 5. At least is what I found, especially given I'm trying to focus more so on the macro, global macroeconomic, rather than geopolitics. The reason I'm not looking too closely at the geopolitics is I didn't really find much that was particularly interesting, or if you're a person who follows geopolitics, I don't think there's much that's particularly interesting to you in these reports, unless you want a more in-depth discussion, which again is not what I'm trying to do here. So it didn't really have much to offer for this project specifically. Starting with growth itself, generally people are positive about growth. These publications are positive. They are optimistic. They expect the global economy to grow at a healthy pace. IMF projected 3.1%. That was in October. Goldman Sachs has above consensus projections. The consensus is a Bloomberg survey, sort of what people using Bloomberg terminals basically think. Fidelity has an upside and a downside case. The upside case is 4%, which is quite high. Their downside case, interestingly, is 2.5%, which is still quite close to consensus. So overall, you can see that people are fairly optimistic about global growth. Even, for example, in Fidelity's down case, it's quite optimistic. They have several drivers that you find across these reports. One, which is kind of funny at this point, is reduced tariff drag. So a reduced effect or drag on global growth led by the tariffs that we saw. Again, this is funny now given recent news. So probably we're going to see people changing their mind about this. In fact, I think I just saw someone post to that effect, but I'll get into that later. But yes, earlier KKR had expected the tariff rate to fall from 17% to 15%. But again, we're probably going to see movement in the opposite direction. Already there was reports, President Trump announcing tariffs on European countries and upping the rate in June. Secondary sanctions on countries dealing with Iran. So, and this geopolitical status quo is kind of in flux right now. So I kind of expect the tariff rate to go up, if anything. Anyways, the other drivers are tax cuts in the US, led by the One Big Beautiful Bill Act, front-loading a boom. So these tax cuts mean people will have more money, more disposable income because of the tax cut. Pardon me. Yeah, more disposable income, more money to spend, drives consumption, can drive growth in the short term, especially in the front end of the economy. So that's why it's called front loading, but probably not a longer term sustained driver of growth. What's happening to me, damn? Okay. Other than that, they expect generally accommodative fiscal and monetary policy globally. For China specifically, they expect China to keep growing, driven particularly by strong exports, which will manage to outweigh probably its sluggish domestic demand. For Europe, it's a mixed bag. I don't Nobody seems to expect great things from Europe, but what growth you will see in Europe, they expect to be driven probably by fiscal stimulus in Germany, driving more investment in infrastructure and such, as well as defense spending, as well as strong growth in Spain, which I think is growing roughly 2.4, 2.6% based on most people's projections, and then AI. But a big asterisk on AI. Um, Mixed bag there, things to discuss there. We'll get to that later. But it may be a driver of growth. It has been a driver of growth in equity markets, and certainly most people do expect it to continue to drive growth in the market. Although how much of that is tied to the real economy is really the interesting thing. But I'm getting ahead of myself. Inflation. Yes, generally, most people, especially again October, November, December, were saying that they expect inflation to moderate and to go close to central bank targets. But you have some differences, and more differences arising now, actually, now that we're in 2026. But I digress. Goldman Sachs was the most confident about disinflation. They expected U.S. Core inflation to fall from what it was at 2.8% to the 2%-ish target near by the end of 2026, driven by the again fading tariff pass-through, shelter disinflation, and slowing wage growth. However, not everyone agrees. The IMF, for example, in their October report, also highlighted that there was an upside risk to U.S. inflation going higher. And KKR, most interestingly, they had the most in-depth discussion about this. Things were in a regime change. So they think that inflation is basically resetting at a new floor. So if the floor was 2%, which is what Goldman Sachs expected to return to, KKR thinks the floor is actually at settling at a new higher resting heart rate of around 2.5%. And that inflation as a result won't manage to fall back to 2%, but will probably be closer to 3% by the end of 2026. And they're not the only people who think this. Interestingly, just before I began recording this video, which is why I don't have it on a slide, I saw a post on LinkedIn by Lazard's advisory by Peter Orszag and Adam Poston of Lazard. And this is a quote from them. The consensus view among forecasters is that inflation will continue its gradual descent towards the Federal Reserve's 2% target through 2026. Similarly, market pricing suggests investors believe the Fed has largely won its inflation battle. In our view, however, this optimism is premature. We think it is more likely that inflation will surprise to the upside, potentially exceeding 4% by the end of 2026. The core drivers are the lagged effect of tariffs. So interestingly, actually, I'll finish the quote. The lagged effects of tariffs, an expansion in the fiscal deficit, which could exceed 7% of GDP this year, a tighter labor market reflecting the effects of the shift in immigration policy, monetary policy that is looser than commonly appreciated, and inflationary expectations that are drifting upwards. We believe these factors outweigh the downward pressure trends that consensus has been fixated on, namely the ongoing decline in housing inflation and gains in productivity. So you see what I have written here, where Goldman thinks that there's a fading tariff pass-through, shelter disinflation, and slowing wage growth. So very directly, Lazard thinks the opposite. They think that the upside pressures are going to outweigh whatever shelter disinflation you have. They don't think the tariff pass-through is really over. And then again, with more tariffs being levied potentially, I'm inclined to agree. So this is more in line sort of with what KKR is thinking, although they go a bit further. KKR again expects inflation to settle around 3% by the end of 2026. Lazard now, in this more recent publication, seems to be thinking it's going to be around 4%, which is very interesting. And related to inflation, of course, is interest rates. I'm not going to get much into this, except to say that a key risk that all these reports from the end of 2025 highlighted is, but perhaps not strongly enough, is central bank independence might be eroded. That's something to keep an eye on. And yeah, anyways. On the United States specifically, Goldman Sachs expects 2.6% US growth versus the consensus at the time of 2%. So they're quite optimistic about the US's growth prospects, and see especially strong growth in the first half of 2036. Again, that's largely due to one big beautiful bill being front-loaded as discussed. Again, Goldman expects the tariff drag to be reduced or fading, and also easier financial conditions. So accommodative monetary and fiscal policy. KKR forecasts 2.3% growth, which is also above consensus at the time, and it emphasizes that this is going to be most likely driven by a growth cocktail comprising the AI capital expenditure boom. So as these big companies, these big AI companies invest in their capital, that's going to drive a boom. But also there's going to be household wealth effects, probably because of that one big beautiful bill as well. And these things are going to drive growth as well. Fidelity also emphasizes that AI-led wealth effects combined with fiscal stimulus will drive consumption. So they're all kind of in agreement with a bunch of this. Fiscal stimulus, AI-driven wealth effects, fiscal stimulus-driven wealth effects, more consumption, higher growth. Pretty much in agreement here. Couple of interesting things to say about AI, but again, gonna get to that later. On China, again, everybody is also quite optimistic for China. Goldman Sachs forecasts 4.8% growth for China, which is above the then consensus of 4.5%. They expect their export-led growth to continue. And in fact, interestingly, they projected, I think the Goldman Sachs report was in November, if I'm not wrong, but they had projected at that point, or was it October? October or November. They projected that China's current account surplus would reach 1% of global GDP in the next 3 to 5 years, which would be, quote, the biggest surplus of any country in recorded history. Now, the funny thing is, Goldman thought this would happen in the next 3 to 5 years, but based on the data, some analysts said that it basically already happened. China has already hit 1% of global GDP based on its trade surplus alone. Anyways, Fidelity expects China most likely to enter what it calls a controlled stabilization outcome of 4.5% growth. They emphasize that the government will continue to use reactive fiscal and monetary policy rather than an aggressive stimulus, sort of like the one big beautiful bill. Critically, they note that the property sector, which China has been having trouble with, will remain a 1.5 percentage point drag on growth. So they expect, actually, interestingly, 4.5% growth in spite of that huge drag. And most interestingly and most relevant for policymakers in China, if any are watching, and I know you are, is that China's services sector is relatively quite underdeveloped. I believe it accounts for, if I'm not wrong, I looked at the data a while ago, so don't shoot me if I'm wrong, but the services sector in China is about 50-something%, and it's about 66% for other industrialized nations. So bit of a sanity check there. It's not necessary that any two economies look the same, but it does, like 10% is a big number. So it does seem like their services sector is underdeveloped, and it does seem, from my understanding as well, that that's a priority for China in its 5-year plan as well. But I'm not a China expert. KKR also forecasts 4.6% growth for China and has an in-depth analysis of China's structural challenges. They note that despite global rebalancing in terms of trade due to geopolitical reasons, due to the tariffs, China still accounts for 30% of global manufacturing output. However, and this is again related to what we were saying about the services industry, as China automates with robotics, as the AI productivity boom increases, and you have these productivity gains and this automation in the manufacturing industry specifically, KKR forecasts that this could eliminate between 90 to 100 million jobs in China over the next decade. So that's going to be a lot of people out of work in China. And this combines, irritatingly, with the fact that China has an underdeveloped service sector. So because the service sector is not more developed, it's less capable of absorbing those unemployed laborers. So there's not somewhere for them to go unless China manages to further develop its services sector. About Europe, which went from calling others the sick man of Europe to being the sick man Europe. Most forecasts for Europe are in sort of the 1% range, about half the United States or less, depending on who you read and when you read. The upsides for Europe are German fiscal stimulus, infrastructure spending in Germany, defense spending in Germany, Spain's growth, which is outperforming most of Europe. But they're not super optimistic. There's strong downside risks because of both the US, as you see recently with the announced tariffs that could also go up in June. China competing with China because of China's, again, huge export-driven growth, competing with Europe's own manufacturing industries. And then structural issues that people love to complain about, such as overregulation, high energy costs, that I don't need to tell you smart people more about. The labor market generally is also an interesting story. So Goldman Sachs shows that jobs growth across all major developed markets has fallen well below 2019 levels, even with solid GDP growth. The US unemployment rate has risen from 4.1 to 4.6% despite good economic news. KKR emphasizes that productivity gains are also accelerating, but that this raises the bar for how much GDP growth is needed to create jobs. They note this is most pronounced in the US technology sector, where employment has been declining even as output soars. So, the problem here, basically, from my understanding, is AI and automation as well, but specifically AI. So you have these huge AI companies and sort of BlackRock had an interesting phrase for this. They said that micro is now macro. So it's a small number of firms, but they are so large in terms of value that they have macroeconomic effects. And anyways, you have these small firms that their capital expenditure is driving such aggressive growth through wealth effects, through equity, driving growth in equity markets, which maybe that's a bubble, but that's another issue we'll discuss later. Um, but the direct impact of AI on the economy is not necessarily quite large, in the sense that uh, most of the output so the AI basically increases productivity per worker, but what that also means is you need less workers. So it's a weird situation where output's increasing but not employment. And I think about this in terms of the financial services sector. If you think about investment banking, an investment banking analyst has a job that a monkey could do if a monkey could do an Excel sheet. And the senior analyst, the associate, the AVP, if he can teach an AI to do that same job, why would I waste a paycheck on someone when I could just do that myself? So if productivity increases, and for the same or greater output, I need less people. So you're going to see that in spite of growing GDP growth, in spite of greater output, in spite of greater productivity, there's not going to be more jobs. So the labor market is soft and expected to be soft. And then in geopolitical terms, interestingly, in different countries, you're going to see another problem, which is a shortage in the labor supply. Because you see, and I don't need to tell anybody this, there's higher fragmentation, there's more nationalism or protectionism, there's more anti-immigrant bias throughout the globe, basically. So, and which is translating into more restrictive immigration policies. So there's economies which may have a shortage of labor and are likely to have a even greater shortage of labor in coming years and decades, but are having more restrictive immigration policies, which could reduce growth. It's going to have uh, it's going to cause it's just not sustainable really in the long term. The potential caveat here is that both of these risks cancel each other out. So if an economy is lacking in labor, maybe the productivity gains from AI can overcome that, but more likely it's a case by case basis in terms of if an economy is lacking in labor, if there's a shortage in labor supply, is it high skill labor or low skill labor? Is that Are those specific jobs where I need more, hands on deck? Are those jobs where AI can actually help with productivity at this stage in the first place or not? Because if I need more craftsmen and shipbuilders, then AI is not really going to help me with that. But if I need more investment banking analysts, then I don't really need the immigration. But that's on the labor market. On AI, yes. Like I said, BlackRock. The AI build out is dominated by a handful of companies whose spending is so large that it has a macro impact. Taking a view on these companies requires assessing whether the macro math adds up. KKR notes that these AI hyperscalers are now using 60 to 70% of their operating cash flow on capital expenditure. So most of their operating cash flow goes into capex, into increasing their capital, and are increasingly using debt financing. Additionally, Goldman observes that the direct impact of AI investment on GDP is minimal because semiconductors, which are used to power this AI boom, are imported and classified as intermediate inputs. So they don't really show much effect on the GDP directly. More so, their impact is indirect. So combining these insights, massive AI spending is creating corporate leverage in their balance sheets and the stock market and stock market wealth effects. So as these companies grow, they spend on capex, it creates strong stock market wealth effects. But this does not necessarily translate into proportionally greater GDP or employment gains. This creates a potential fragility, wherein if AI monetization disappoints investors, you get both a reversal in the wealth effect and a reversal in leading in the sense that there is more leveraged balance sheets. Oh, this is my last slide. I thought I had more slides for sure. Uh, but yes, that's just quick takes, key insights that I found in these several reports. To sum up, overall, they expect global growth to do fairly well in the coming year. Some challenges, some risks, especially AI is the important one here, I think. It's both a potential driver for growth, but perhaps a mirage because it doesn't have how much of a direct impact does it actually have on the economy. I recall there was actually a paper by Daron Acemoglu, who actually won the Nobel Prize in economics last year, or the year before rather, actually. And he also said that he didn't expect, in that paper, that he didn't expect AI to actually drive much growth in GDP at all for the next 10 years. Um, and if that is the case, then it seems that most of the growth you see driven, quote unquote, growth you see in these AI companies is mostly just spending on capital expenditure and inflating equity stock prices, which to me sounds like a bubble. To a lot of people, sounds like a bubble. Even in BlackRock Investment Institute's report, if I recall correctly, they suggest much the same, that even if it is a bubble, the bubble can still grow before it bursts, which that's what you want to hear from your investment team. Uh, oh, also disclaimer, this is not financial advice. None of this report is financial advice. Should not be taken as such. I'm just some dweeb on the internet. Yes, other than AI, labor markets are a concern for geopolitical reasons in terms of restrictive anti-immigration policies, but also because you have more output, more productivity because of AI and automation, but that does not translate into more jobs. Growth people expect to be driven by generally accommodative monetary and fiscal policy, although with an erosion in central bank independence, it's interesting to see where that goes. Inflation, to reiterate, the interesting piece about inflation is that while many expect it to trend towards target levels or the floor, so for example, Goldman expects it to trend back down to 2%, some are now suggesting, especially particularly KKR and Lazard very recently, that there's now a sort of higher resting heart rate for inflation of 2.5% is what KKR says, and Lazard expects inflation to end at around 4% by the end of 2026, which also makes, oh, and also KKR has a very interesting insight, I recall. I'm sorry I didn't put it on a slide, but they also think that due to higher inflation, which they expect to continue, they have what they call a regime change hypothesis. No, this is not about Iran. They expect basically that as inflation has increased, they say that there's a stronger correlation between movements in stocks and bonds. So bonds no longer work as a shock absorber for stocks. So they say that if you look at the data, and I have not looked at the data myself, I'm taking their word on it for now. But if you look at the data, that in periods of sustained higher inflation, there's a stronger correlation. Bonds and stocks work in the same direction. So you can't really use one to diversify from the other, which is a very interesting insight. Again, not financial advice. I'm not saying buy bonds or don't buy bonds, or buy stocks or don't buy stocks. You do you. But yeah, just some stuff I found. And this was mostly for myself, but I hope somebody else also finds it interesting. Goodbye.